Dear viewers, your investment portfolios will go through multiple number of risks. In this episode, I am going to talk to you about the 11 risks that your investment portfolios may go through. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Risk number 1, risk of volatility. What is volatility? The price is moving up and down. You buy something today, tomorrow its price may be lower or higher. And if you need money, you may be forced to sell when the prices could be lower. So volatility in truest term is a temporary loss. It is not a permanent loss. If you sell this asset when the prices are low, this assumed loss or a temporary loss is converted into real loss. The other way to express the volatility could be it's a notional loss. It will not result in actual loss. Only when you out of fear or your need, when you sell that asset, it can be converted into a real loss. How can you avoid this? Very simple. If you need money within next 3 months, 6 months, 1 or 2 years, do not invest that money in any asset which has a volatility. It could be gold, it could be stock market, mutual funds, or any of these things. The volatility will normally subside over a longer period of time. Let's say if you have got 5 years, 7 years, 10 years period of time which is working for you, then you can invest in that asset which has a volatility. Risk number 2, risk of lack of experience on your side. These days, do it yourself is gaining ground. What is the problem with do it yourself or lack of experience? You may do things not in an optimal way, not in a right way. So if you do something in a wrong way, it can result in losses. The other side could be that it may not generate the rate of return which it should normally generate. We call it as suboptimal results. How can you overcome this particular risk? Simple. Either you spend enough time, gain experience, read through it, take time to understand the concepts very well. This is one methodology, but it takes long time. The other method could be engage professional advisors who can help you to overcome this problem of lack of experience. Third risk is risk of illiquidity. You invest in an asset class and that gets locked for a long period of time. For example, you invest in real estate, you invest in a product like National Pension Scheme, or you invest in a product like ULIP, Unit Linked Insurance Plans, which get locked for 5 long years, or PPF accounts. So all these things have got illiquidity which is built around it. It's not a risk in real term, but if you need money, you may not be able to liquidate this asset at will. In some cases, you can find a way around it. See, for example, if you have got real estate, you can collateralize it and take a loan against it. So illiquidity is a disadvantage, is not really in the form a true risk. So if you need money, you may not get, but you can collateralize the asset that you have, provided bankers are prepared to give loans against that. Risk number 4, risk of reinvestment. What is reinvestment? You invest in some instrument today and it matures at 3 years, 5 years, at some point of time in future. You don't need that money at that time and you have to reinvest. Now when you reinvest, the chances of you getting the same return or higher return or lower return is not known now. So it exposes you to a possible risk that when you reinvest this money in future, probably you could be getting a lesser return. This reinvestment risk occurs with respect to individual stocks or a mutual fund portfolios also. See, for example, somebody feels that the markets have run up a lot and they try to sell it thinking that the markets will come down. Instead of markets coming down, markets may continue to move up and you may think, oh, it will not come down further, and you will go and reinvest at a higher level. So reinvestment risk can express itself in different forms in different asset classes, but it is a risk which is real. Dear viewers, watch this video till the end and leave your comments below with your opinion of which are the 3 risks you feel are the most dangerous out of the 11 risks that I am going to talk to you now. Risk number 5, risk of currency exposures. This may not be that important for a resident Indian unless he has exposed money for another currency outside of India. But for NRIs, this is a real risk. Say for example, you live in United States and you deal in dollars, but you invest your money in Brazil, you invest your money in South Africa, you invest your money in England or in Eurozone or in India. So you convert your dollars into some other currency. When you sell these assets, the exposure that you take is your currency that you have invested, Indian rupee or a South African currency, Brazilian currency, Chinese or any other currency could be lower than the previous values at which it was invested. The convertibility of a foreign currency to back to dollar could be a different one. It can cut on either sides. Maybe you get a better return, but maybe you get a lower return. But chances of when currencies gets devalued, coming back to their previous level is almost negligible. Now we have seen rupee was at 45. The rupee got devalued, it went up to 68. Did 68 come back to 45? It did not. 68 came back to 62, 63. There will be waves in that. But coming back to the original level previous will not happen. Likewise, 68 has become 82 now. 82 may become 78, 79, or maybe come back to 75. That's a possibility, but it will not go back to 68. So the currency risk is a huge risk which gets built in your portfolio. Managing currency risk is not easy. In some of the countries, the currency risks are so huge. Argentina, Brazil, South Africa, different emerging market, the currency risk is very, very huge. To manage the currency risk, you definitely need professional assistance. It's not something which is easy to manage a currency risk. And the losses that might result from currency risk will be the real losses that your portfolio suffers, which you cannot recover unless your investment portfolio, the asset class that you have chosen, itself gives you a very high rate of return. Risk number 6, risk of leverage. What is leverage? You have less money, but you buy more than what you can really afford for. Futures and options could be one of the places where you expose your to leverage. NRIs have another way of leveraged buying. See, for example, many banks will approach you. They will tell you, you can borrow money at 1%, 2%, but this particular bond is giving you 4.5%, 5% rate of return. And you will bring 100,000 US dollar. The bank will give you 200, 300, 400,000 US dollar as a borrowing. You borrow at a lesser cost and you invest for a higher return. But this has huge risk. If the bonds go through a deterioration or if the bond prices fall, the banks will ask you for a collateral or they will liquidate this. Likewise, when you call it right, the leverage can work in your favor. Leverage can cut on either side. You may make huge profits or you may make huge losses. Both possibilities exist. Again, the risk of leverage is huge and it is real. Risk number 7, risk of chasing momentum. What is momentum? Momentum is the prices are on the move. Gold moves up, the land prices will move up, real estate moves up, the stock prices move up. All these asset classes at some point of time starts moving. Now when it starts moving, we do not know at what point of time you enter this asset. The momentum becomes intense when more and more people start talking about it and it becomes fashion of the day. At that point of time, if you try to buy, you do not know whether the asset class is still continuing to go up or it will go and fall down. Again, chasing return is a real risk that you will be entering during the bull markets. Risk number 8, risk of disinformation. What is the risk of disinformation? When the prices are moving during the bull markets or when an asset class goes through a bull run, there is plenty of information which is available on the television, in the newspapers, through the SMSs, WhatsApp forwards, and you might believe that such and such a stock will move up, you are going to make so much of your money. This is disinformation. You have to be very careful about it. Either you should know about it thoroughly yourself well, or you should consult your professional planners. Do not succumb to disinformation. Disinformation is a real risk and it can result in massive losses for you. Risk number 9, risk of overexposure. Overexposure is similar to leverage. Whereas in case of leverage, you buy it without the money that you have. In case of an overexposure, you buy it with your own money. But you overexpose your savings into one single item excessively. A classic case was in one of the videos I had discussed about one person who bought gold using all his savings because gold was moving up. When you overexpose yourself to a stock or to an asset class or maybe to real estate or anything, one of the two things will happen. If that asset class performed as you expected, you could be sitting on huge profits. The other side could be that you incur huge losses. Both possibilities exist when you overexpose to any specific stock or asset class. So the risk in case of overexposure again is real and it can cut on either side. Dear viewers, I am a practitioner of finance. We understand all elements of risk very, very well. We manage portfolios with good understanding of risk. We help people minimize the risk in their portfolios. We have helped thousands of families spread across globe in building portfolios in a very efficient way, tax efficient way, managing the risk and helping them achieve their life goals. If you are looking out for professional help to build your portfolios in a wise, safe manner, you can make best use of our services as well. You can reach to us through a WhatsApp message on the number that is shown here on the screen from any corner of the world. If you have an intention, the time to send the message is now. Risk number 10, the risk of permanent loss of money. This can happen with any asset class. This can happen at any point of time. It may show up without any previous knowledge. You would have seen some of the banks going bust. It could be a classic case of risk of permanent loss. Some of the companies simply die out. Satyam is a classic example. Enron is a classic example. You may completely lose money. Builders run away and you are left with nothing. So the loss of losing money permanent is a huge risk which is there in your investment portfolio. When I talk about investment portfolio, it's just not a mutual fund or a stock. You should look at every asset class. Even an art, if you consider as an asset class, you may not find a buyer at all. Nobody may be interested. Its prices may fall or it may be lost in an accident or a fire. Anything could happen. So when you invest in something, look at what is the probability of suffering a permanent loss. Dear viewers, these are not the complete list of risk your investment portfolios which will go through. I have listed here the major ones. There are countless of them which will exist. For the sake of keeping the video shorter, I have chosen only the important ones here. Risk number 11, risk of non-disclosure of material information while filing the tax return. This is particularly very, very important to the NRI community. If you think I have got some assets outside of India, I need not declare it in India is not the correct version. In fact, we have done a detailed version on what are the foreign assets that you have to declare in India. Please make sure you watch this video and be guided. If you do not disclose the proper information, these days IT infrastructure is so strong and it can get hold of this information, you could be served a notice and the penalties could be very heavy. If you think what you maintain outside of India cannot be known in India, that's also is not correct. Governments have signed treaties now. They have a dynamic exchange of information. Your bank accounts outside of India through a FATCA laws or through exchange of information between two banks can be known to the tax authorities in India, in your country as well. So make sure you disclose things properly to the tax authorities and don't invite unnecessary penalties. Whether your portfolios perform less or whether you pay the penalties, it is going to be a cost. So the risk of non-disclosure is also pretty huge. Dear viewers, hope the video that I have done today helped you to understand the 11 major risks your investment portfolio may go through. If it did help you to understand the implications of this risk, please like this video. If you are a person who is watching my channel for the first time, or if you are yet to subscribe for the channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you next Friday with yet another topic.
Press the bell icon for more details and subscribe our channel.